Hey everybody, welcome back to my channel. Today's video, I'm going to answer a question that I got from a follower on Instagram. Their question was, are we going into a recession? The good old R word is being thrown around left and right. But before we get into that, let's talk about how things were going into 2022. Going into 2022, things were actually pretty light and airy. We were looking forward to a global recovery coming out of a 2-year pandemic. Now, you would see, this is actually JP Morgan, you would see analysts come out and say things like, our view is that 2022 will be the year of a full global recovery and an end to the global pandemic and a return to normal conditions that we had prior to COVID. We believe that this will produce a strong cyclical recovery, a return to global mobility, aka traveling, people getting around outside of their countries, and strong growth in consumer and corporate spending. You'd think that, yeah, people are going to get out more, they're going to travel more, they're going to spend more. This was the consensus going into 2021. 2022 came along and gave us all a run for our money and crushed our hopes and dreams slightly. So what do I mean by that? Well, now we're going into a situation where we already had high inflation. I've talked about this ad nauseum. And now we've got a war on our hands between Russia and Ukraine, which affects everybody in one way, shape, or form due to commodities and supply chains, energy, yada, yada, yada. So now we are going into a situation where we already had high inflation. Now we're looking at even higher inflation. We're seeing that as oil prices continue to soar, metal prices continue to soar. These are things that go into products that we use in our everyday life. It goes into batteries for EVs. It goes into, metals go into all types of different products and have many industrial uses. And so this is going to be a trickle-down effect as we see these commodity prices soaring, inflation continues to be higher. So we're not really seeing much of a reprieve. And to add insult to injury, we have wheat, we have fertilizer, things that feed the world that are coming out of Russia and Ukraine that are going to be cut off, and we're going to have supply issues. So this is really looking to be more concerning than anybody could have probably imagined coming out of 2 years of crap in 2020 and 2021, and now going into 2022 with more crap. So here's where we're at. Trying to parse through all of the economic data, all of the different things that you can look at to try to determine if we're going into a recession or not. It's become quite overwhelming. Even the greatest out there are saying, I don't know what is going to happen. Some people are more confident than others that we are going into a recession. Some are not so confident in that, and there are factors that are leading them to believe that we are likely not to, maybe we'll be on the brink of recession, but we won't actually make it there. The data is very contradicting. Right now, the way that I'm kind of seeing it is we are playing tug of war here. We have a big rope, right? And on one side, we have all the bad things that could spin us into a recession. And on the other side, we have all the things that could help us kind of avoid recession and keep the economy chugging along. Yes, we're going to take a hit to growth. That is being reflected in gross domestic product forecasts. We are now seeing GDP growth being brought in. Here's an example. Goldman Sachs has cut their US 2022 GDP forecast. They've cut it from 3.8% down to 3.2%. Now, with that number top of mind, keep in mind that the average GDP growth rate, it tends to depend on what decade, what time frame you're looking back through. But, over the past few decades, we've seen it be around 2% on average, give or take. So seeing a GDP rate basically 3% or higher is actually not too bad, and it's getting us more back to normal. And you can kind of see that reflected here in the US real GDP rate. Quarter over quarter is what this is measuring, the percentage change each quarter. And, you'll notice that on average, we stay pretty steady. And then here we had the pandemic happen, and we had a very sharp decline in GDP as the economy shut down, and we had a very sharp recovery in GDP. So of course, because we came from such low numbers, the GDP growth rate was very high, and we're starting to come back down and stabilize, getting back to pre-pandemic growth levels. So the economy is expected to still grow, even with everything that's going on. It's going to take a lot, I think personally, for us to see a few quarters of negative GDP growth. And that is where, when you start to see negative GDP growth, when you start to see unemployment rates rising, we can see that the unemployment rate is down to pre-pandemic levels. And this is all in the face of a labor shortage. So it's really difficult for me to foresee us seeing unemployment rates rising again significantly when we have so many job openings out there that we still need to fill, and we have such a tight labor market. So we're kind of in a very interesting spot, and it's making it very difficult to try to pinpoint if we are actually going into a recession or not. So what I want to do is I want to break my thoughts down per data set and really dig into where we're at, how the consumer is truly doing, and what can derail the consumer enough to bring us into a potential recession. The consumer has been spending, even as savings rates have started to come down, and we have seen stimulus roll off and kind of be sucked up into the economy. We're still seeing people spending money at higher than average rates. So that is actually aligning with the fact that we're also seeing consumer debt as a percentage of disposable income. We're actually seeing that level rise again. So what that tells me is consumers are spending, but since they have spent down a lot of that excess savings and savings rates are back down to pre-pandemic levels, we are seeing them start to take on debt to fund that spending. And just so you can see it, I'm going to go ahead and add the U.S. personal savings rate here and show you what I'm talking about. So this is the U.S. personal savings rate. We saw a large spike in the depths of COVID. A lot of people couldn't spend money. They couldn't leave their houses. They weren't driving, yada, yada. They weren't traveling. And so we saw that large spike in savings. And then we've seen that personal savings rate come down, meaning consumers are not saving at the rate that they were, during the pandemic, and they're saving at the same rate that they were prior to all of this happening. So the good news is we're still seeing the consumer save. They're saving, not at a super low rate, nothing below average, pretty much looking at average. Now, what's going to be concerning is if that rate starts to come in more, that means that high gas prices, inflation, high food prices, things like that is starting to eat into the consumer's ability to save, especially if we see that come in with consumer debt rising. So that's something to watch out for. But as of right now, overall, the consumer is not in bad shape. Not only that, we have houses that are appreciating their assets, hard assets are appreciating, helping them have some equity. Obviously, that's an ebb and flow. It goes up, it goes down. Debt that has been issued has been higher quality debt for homes. So, that's a good thing, very different from the 2008 financial crisis. Something to kind of look at if I zoom out, when we look at the grand scheme of things, like I've mentioned, the debt levels are not where, they have been historically in terms of how much people are taking on debt in relation to their disposable income. But we are seeing that rise. We did see it come in quite a bit, which was nice to see, but we're seeing it rise again. So this is just kind of something to watch. High debt levels are, can be a risk to the consumer, absolutely, especially if it's consumer debt. And we're talking about consumer debt being credit cards, personal loans, things like that, that typically have higher interest rates versus, mortgage, which is going to be a secured loan that is a hard asset that actually can provide equity for you. So those are two very different things. And what's even more interesting to see is the U.S. household mortgage debt service as a percentage of disposable income. And that level has come down tremendously over the past decade or two. And it just tells us that the overall consumer is better off than they were, in different times of history, especially going into some unknown times and potential, recessionary environments. So you're probably wondering, okay, that's all great, Nikki. That's all, rainbows and sunflowers, but there's a lot of bad stuff going on right now and we are doomed. Well, you're not wrong. There is a lot of bad stuff going on right now, and we need to be extremely cautious going into what our expectations are for this economy going forward. Now, to start, gasoline prices, oil prices, which bleed into gas prices at the pump for people like you and I. Now, people driving Teslas, yeah, we know you don't have any trouble at the pump. Good for you. It's a trickle-down effect. We're all having to deal with this in one way or another. Maybe some people aren't as affected. If you have solar panels on your roof or if you've got, an electric vehicle, totally understand that. But for most people, this is going to affect their pocketbooks. Now, let's start with gas prices. Gas prices have reached a new all-time high as of today, actually. We have breached the high that we saw in 2008, the 2008 financial crisis. Now, one thing to keep in mind is that the consumer's been here before. We have seen high oil prices in the past. So this is not something that we can't recover from if things can turn around quickly from here. The problem becomes if gas prices continue to rise from, via oil prices rising. That is where this is becoming a bit troublesome because we don't know how high things can go from here. I've heard speculation that we could see crude at $200 a barrel, which is a lot higher from here. I think today we're printing somewhere in the 120s per barrel. So, it's very difficult to say. So generally, yes, the consumer has seen these higher oil prices before. They've been able to recover from them. Commodities are very volatile. Prices go up quickly. Prices go down quickly. The problem here will be if oil prices stay elevated for a lot longer and go to levels that we just haven't even seen. If gas prices go a lot higher from here, we are going to see the consumer pull back. If oil-derived products become more expensive, that's going to cause issues with the consumer. So this is definitely something that we need to monitor. And if prices start to stabilize from here and we see oil reverse and pull back, because there is a lot of speculation going on right now in the trading of commodities. The traders have gone to where the money is. And as we know from growth stocks, traders can push things a lot higher than they deserve to be. So, the question is how much of what's going on in commodity prices being driven by the actual fundamental events going on between Russia, Ukraine, supply chains, and all of that. And then how much of it is coming from speculation from traders, pushing these markets up further than they actually need to go. So that's yet to be seen. The volatility will show itself, and we're going to see, that come probably quicker than we think. But for now, we're on watch. The other thing, is all of this is happening as the inflation rate has been increasing. So this is bad. The inflation rate has been insane. Oil prices have absolutely contributed to inflation. We have seen grocery prices higher, but oil prices have been the culprit. Used automobiles have been the culprit. Those have been like the two things really driving this inflation rate super high. We have seen the inflation of groceries increase as well, of course, but not at the same rate that we've seen used automobiles, new automobiles, and oil, and just energy in general increasing. These things we're expecting to kind of come in. We're expecting, we're already seeing used autos. We're seeing those come in. Those prices are stabilizing a little bit more, still elevated, but we're seeing that start to turn around. Inflation is roaring. It's going to continue to roar, and I think it's going to stay elevated for a very long time. I think this is going to be with us, and my forecast of seeing inflation going forward around a persistent 3%, which is higher than average that we've seen over the past decade or so, I'm thinking it can be even higher. So I'm actually siding with the stock geek on this one. I think he was saying, in between 3 and 4%. I think that that's very possible. We could see upwards of 4%, 5% pretty persistently for the next few solid years until this stuff works itself out. It needs to freaking go in a timeout and figure itself out, right? So that's the bad. Even with the consumer being healthy, if this stuff continues to go the direction that it's going, look, not only do we have the consumer that's going to have to dip into savings more, they're going to have to spend more of their disposable income, but also we have other economies that still haven't opened up yet that are really needing tourism. They're really needing people to come and spend, and that could be curbed by this inflation. That could be curbed, that trip to Europe that you were going to take, and you were going to fill someone's pockets by purchasing an Airbnb and going out to eat at restaurants, in Italy or wherever you were going to go. If you decide not to do that anymore because your pocketbook is getting pinched because of this inflation, then that's going to affect us globally. The world was really depending on reopenings, traveling. The airlines were going to open up flights internationally more. We were going to start seeing more of that world travel that was going to help spur global growth. And now that's at a huge risk. All right, let's talk about company earnings. Let's talk about earnings growth expectations, because that weighs huge on the stock market. That weighs huge on what our portfolios are going to do and what valuations are going to look like going forward, and if there's going to be opportunity here or not. So this is an S&P 500 revenue and earnings annual growth forecast chart. This actually shows, this is from Yardeni. Yardeni publishes awesome data. Highly suggest taking a look at all of the things that gets put out there, yardeni.com. And so this is 2022. We saw 2021, the growth forecasts were very high. Growth was high. Stimulus, remember, all of that. 2022, we're still seeing the consensus saying that we are going to see revenue growth with our corporations, okay? This data is through 2/24/22, and obviously a lot of things have happened since then. It's now March 8th, so before people were thinking the consensus was around 9%, but since then that's probably going to come in quite a bit. I don't know what that number is going to be, but my guesstimate, especially with all of the companies that have come out saying that they are reducing their revenue guidance because they're pulling out of Russia, which is going to impact their revenue overall. I think that we're going to see S&P 500 revenue estimates down. Maybe we get lucky with mid-single digits, 5% or so, but it's definitely going to look a little more grim. 2023, they're expecting even lower revenue growth from 2022. Obviously, things are kind of going to start normalizing again, but, companies are coming out saying that their revenue is not going to be what they thought because of what's going on in Europe. Now, does that put us in recession territory? Does that put us in, a deep bear market in the stock market? That's really tough to say right now. Like I said, I think we've got that tug of war going on between the positives and the negatives. And, the negatives are big negatives, and we need to definitely be aware that it's possible that growth is going to take a severe hit. And the Federal Reserve is expected to raise rates starting in March. We're about in a week. We're going to see a rate hike of about 0.25%. And that's going to probably continue through the year. But we think that the Federal Reserve is not going to be as aggressive as we thought they may be because of the war that's going on and the hit to growth that we're going to see. That's something that I think the Fed is absolutely considering. They don't want to get too aggressive here. So what that means is we're going to continue to have high inflation and low interest rates. That means we are going to have a negative real yield. That means that we are likely to continue to see people searching for yield somewhere, searching for returns somewhere, and risk assets are likely to still be in demand. We may see the market sell off. The market likes to price things in advance. The market is shaky right now. The R word is being thrown around. The recession word is being thrown around. It's very possible that the market could continue to sell off, price that recession risk in, and then from there, we're in the same spot we, have been in, where we have nowhere to get yield. The Fed can't raise rates enough to where we can get, great yield. And we're still going to have to invest in risk assets like equities, cryptocurrencies, real estate, businesses in general, and commodities probably. So we really are not seeing much of a shift in that narrative. And so that does make me think that I'm not going to stop buying equities. I'm not, thinking that the world is going to end and I'm going to completely change my investing strategy. I don't see a reason to do that here, even if we are going to see a recession in the near future. So hopefully that kind of outlines the different data points that I'm looking at to try to put this freaking puzzle together. It's a very, very difficult puzzle to put together right now. There are a lot of moving parts, a lot of unknowns, and even the professionals that I listen to are having a hard time saying for sure, yes, this is going to happen. We know it. It's a sure thing. Everybody's a little bit unsure how this is going to play out. So find solace in that. You don't have to know what's going on, but what you do need to know is that historically we've seen ups and downs in many different data sets, and we've seen the stock market and assets in general continue to appreciate, continuing to build wealth for individuals, and I don't see that changing anytime soon. So hopefully, that helps. If you liked this video and if you learned something new, please let me know in the comments below. It really helps me to know what you're learning and how you're feeling about the content that I put out. Give this video a like. Let's help other people find me so that they can learn more about the economy, the markets, building wealth, finance, all the things. And don't forget to subscribe so that you don't miss future videos, and I will see you next time. And I hope that you're staying safe in today's craziness, especially if you are in Eastern Europe. I'll see you in the next video.